Hello, YouTube. We're entering a new week, a new month, a new quarter, and it might be time to sell everything. We're going to update you on that today. After the worst month over the last 3 decades, we're going to update where we should be going from here. We're still in fear, so the market is running based on fear, and we were flip-flopping between extreme fear and fear all day. We had 4 Fed speakers today, and we basically have the whole gang talking today, including Bowman and Goolsby, and basically everyone. But that's not the reason why we're down. Even though we avoided a government shutdown, a U.S. recession is still likely, and it is coming soon. So there's the big man right there, or Jerome. So Jerome is not actually the reason why we're down today. The reason why we're actually down today is because of what Jamie Dimon had to say. So what did Jamie Dimon say? He said rates, 7% rates may come even without the Fed's help. That seems pretty scary. He teased out a worst case scenario, and then he was asked to follow up on a Bloomberg interview today where he said that when asked if interest rates go to 7%, the answer is yes. And that's from the article before. He said he's ready for 7%, even ready for 8%. Why is that such a big deal? Well, because whatever the 10-year Treasury note, tech stocks are supposed to do the opposite. And we're just not seeing that right now. As a reminder, we do not want to see a pivot. All we want to see is a pause, because after the Fed pivots, that's when the big declines start. So what does that mean? Well, it really depends on whether or not it's 2007 or 2008. So I've been arguing that it's currently 2007, which means that, hey, we could not have a recession quite yet. The bears might be right. They just might be early. That's what I believe. That's my current thesis. And don't have to look very much further than the Fed itself. Fed's new inflation outlook already seems outdated, analysts say. What are they saying? We're not likely going to hit 0.3 for the next 4 months to hit that's the Fed's 4% annualized, or basically faster than what we've done so far this year. And here's a quote from John Williams, the New York Fed president, or the number 2 person at the Fed. My current assessment is that we are at or near the peak level of the target range for the federal funds rate. That seems pretty restrictive to me. Not only that, we're into the longest bear market in history for bonds. Oh my goodness, currently at 38 months. Woof, it's already been harsh out there. Already talked about that one. So why are tech stocks up? Like, why is Google up? Why is Nvidia up? Why is Amazon up? Why are utilities down 5%? Man, it's bloody out there. So let's start the show. Let's look at a couple of charts and let's just push it forward. So what I want to start off here is just by looking at a couple of charts. Look at Ether. So Ether is down because we launched the futures spot ETF today. That's almost always a sell because there's new liquidity. I found that very, very predictable, but it went from 1,700 back down here, or a drop of about 6%. We look over to SLV. Oh my goodness. From the Friday open to where we are now, it's down nearly 10%. Woof. That is painful. That is brutal. That is not fun. Utilities. Whoa, wowza, right? One day we're down by 4.5%. That's a huge move for an ETF. IET or KRE. They look pretty soft. We're lower than we were at the shock from the SVB crisis. That's all the way back here on March 23rd, and we were at about 33. We're here at 32.50. So the market is pretty scared. We know what else is down big time. We got the Russell down, right? Russell's looking for a death cross to form soon. We got ART down 1.5%, XLE down 2%. Man, it's bloody out there. Even gold is down by 1%. Whoa, what's going on? So why is the NASDAQ green by nearly 1% again? It's been green for the last 4 days in a row, and the S&P is not. Well, I think here being the key word, that I think by the end of the week, the picture is going to change dramatically. And if not by this week, then by next week. And I say that because we have a lot of information coming out, but this jobless claims in September jobs, I think, is going to be interpreted as bullish. I could definitely be wrong, but that's what I think. Before we jump into this next section here, I'm going to ask you for a huge favor. If you could please consider smashing that thumbs up and subscribing to the channel, I would really, really appreciate that. We put out stock market videos every single day, and I would really appreciate your support. Please and thank you ahead of time. All right. So why the U.S. recession is still likely and coming soon? Well, if we look forward here a little bit, we're just going to read a couple of headlines, and we'll dig into the story more throughout the week. A last-minute deal to avoid a government shutdown kicks one immediate risk a little further into the future. But a major auto strike, the resumption of student loan repayments, and a shutdown that may yet come after the stopgap spending deal lapses could easily shave a percentage point off of GDP growth in the fourth quarter. Why would that matter? Because they're calling for a recession. And as a reminder, when we look here to the GDP, the reason why this matters is because it's calculated quarter over quarter. So If we're going to beat quarter over quarter, we have to deliver better than 4.93%. And we could be facing an uphill battle with many things here. They're giving us 6 reasons why. So soft landing calls already always precede recession. So this graph right here does not give me any solace, any comfort. We look here at the black line. It says number of news articles mentioning soft landing, and then the gray area is the recession. So we get a peak in mentions of soft landing, and then the hard landing comes. Same thing happens here in 2006, and then we get the recession in 2008. Well, oh my goodness, new all-time highs. Whoa. Well, looks like recession may be coming. That's one of the reasons. I don't like that already. Unemployment risks skew heavily to the upside. Cool, right? Excited about that. Nice. A downturn is hiding in plain sight in the forecasts. Uh-oh. So again, we'll dig more into this a little bit later this week. Here's the cascading payroll impact on auto strikes, right? Whoa, there's a lot of people that actually that work and put things into producing vehicles. That's correct. We also note the 10-year Treasury note is rising, and oil is also rising, getting close to 100 here. There's a lot of different reasons. So here we go. Extra savings runoff for most U.S. households. You can see that most of the savings is actually dwindling since the lockdowns. Delinquency rates are low, but they're starting to climb. Okay, well, looks like we got a lot of things to worry about. And when banks get this trick, it usually means recession. Nice, right? We get an excellent predictor here. That seems really good. So I don't really like the sound of that at all. And I don't know if Jerome is trying to do exactly what he's doing, if this has been intentional. I don't know, but I think it's really important for us to be mindful of what could happen. So I want to look a little bit deeper into the relationship between the tech stocks and the 10-year note. But just before we do that, if we look here at the heat map, I want to see whether or not we're noticing a trend, because today it's very obvious that if we go no group, the biggest blocks or the most important stocks for the S&P 500 are the reason why we're only down by about 17 cents here, and the Nasdaq's up by almost 1%. What I would note is that SMH is up by 0.86. It's been back to back green. We got higher lows and higher highs every single day. Same thing here, but we don't have a higher high today on QQQ, but it's up by 0.8%. That's like a pretty big gain. But look at the dollar. Whoa, it's crushing 107. Jamie Dimon, what are you doing, bro? You trying to crash stocks? This is not good. And this is not good for a few reasons, because if the dollar is up by 0.8 and the market is green for the NASDAQ and it's flat for the S&P, one of these things has to give. And I'm not sure which one's going to be. We note that VIX is giving back some of its gains, and we just note that here by the upper wick. So VIX is giving back some gains, but it's still up on the day. The 2-year note, not a new high, not a higher high, but it's right around where we were going back to July. So it's getting a little bit precarious here. And the fact that we have Ether down, I can explain that away from the spot futures ETF coming out. I don't like this, though. This is likely Jamie Dimon here, where we're getting a record close on a 52-week closing high. It's not a record close. It's going back to 2007 levels. So I think that we're arguing currently that we're in 2007, but oh my goodness, I do not like this. We got 5 back-to-back hollow weeks in a row. We're well above 433, which means we got our W. We haven't had the crash quite yet. And that's what's so interesting here. If we look to what happens after the worst month, well, it's usually up. You might be surprised. We went through it on the weekend. I think a lot of bears don't want to look at this reality because it's a little bit sobering that on average, 62% of the time we close green. And if it's not 2008, like we're looking at -3 as the worst next month after that, then -1. But otherwise, we got +2, +9, +10, +7, +8 for an average of 0.2. Sorry, for +2. That seems like pretty good. So here's what I find so interesting. If there's all this negative news, which I believe, and again, keyword here being believe, is ultimately going to get walked back because Jamie Dimon's not the Fed. Jamie Dimon is not Jerome Powell. And we heard from Goolsbee and other Fed speakers last week saying that we actually have to balance the dual mandate. There's actually a risk we could go too high. So if we've already kind of baked in the worst case scenario and we don't sell fear, we buy it. Well, man, we're here in fear. We were in extreme fear a year ago, which was the bottom, by the way. October was the bottom. We were in greed a month ago. Well, we know we sell greed, so we should have sold a month ago, should be buying right now. This seems pretty simple. And I went through a lot of this on the weekend. So what I want to do is really tell a story by going through a few news articles here. So Tesla was gapping down like 3%, 4% earlier today. Tesla reported 435,000 deliveries when we were looking for 461. Why does this matter? Well, arguably, this is bad news. So why did Tesla close up on the day? Why does it have a bullish engulfing candle? I think. Let me just double check. 70. No, lower high, but basically a double top, gap down, pump up, closing green on the day. Man, what's going on? Why was this for buying? Why is Nvidia up? I think it was like 2-3% today, 3%. Well, specifically for Tesla, the fact that it's moving higher on a miss, well, that tells me that people are not buying because of the fundamentals. They're not buying because of what's supposed to happen here, where the yields go up. It's currently above 4.6%. So this has gone up a lot. The red line's gone down, but it's not enough. So what I'm thinking is that people are starting to do what I am predicting, where we're going to find a reason to go higher. We might get that failed breakdown, which we talked about, which means that we might actually go below 422 on SPY, might rally back up. But because we're already seeing synchronized buying for chips, for the NASDAQ, but for names like Tesla, starting last week and going through to today, the saying is that, well, if good news cannot take you down, what could good news do? Well, good news could take you dramatically higher. And I'll tell you the reason why this matters. Because if we think about what drove tech stocks higher into the first half of the year, well, it wasn't fundamentals, it was hype. Read this headline and tell me whether or not you think this could create some hype. The guy who designed the iPhone is reportedly talking to ChatGPT boss Sam Altman about making a new AI device. Oh man, that seems like mega big bull. Take a second to think about what's just been laid out there. And then secondly, we're expecting a release in the next 2 weeks that's going to tell us that you can now prompt ChatGPT with pictures and voice commands. It's basically going to be Siri. So Siri-like functions. It has Google-like features. If they launch an iPhone, a new phone, man, that could be $1 trillion idea. And the reason why this is important is because if this kicks off in the next 2 weeks, I think it's going to create a whole cycle of hype again, where I think we're going to find a reason to damp or to dump yields, where tech stocks can hold the gains. This is not a popular belief right now, by the way. Most people think that I'm totally wrong. I think the bears are right. I just happen to think they're early. And I've been going through all the different reasons for that. But for me, there's an important part of this recipe that I need to see, not want to see. So for me, I need to see one thing here. So actually more than one thing. We can go to, let me go to the last board here. I'll go to, give me 1 second here. I want to go to the correct chart. I want to go to 4 boards, and then I want to pull up my SPX chart over here because this is the one we talked about on the weekend. So there's one thing I'm specifically looking for, and it's a pattern here. But before we do that, let's just pop over here to the previous board on SPY. And I just want to note that I know this sounds like so simple. I shared this on Twitter over the weekend. I've been posting a lot more. So if you want to engage with me, you can do that here. And one more time, if you wouldn't mind considering subscribing to the channel, I would appreciate that. But basically, I said, I'm asking for a friend. Is this chart bullish or bearish? And instead of just telling me if we're bullish or bearish, I'm getting all these men, mostly men, trying to mansplain to me why we're pointing up. But here's the reason why it's bearish. So it's simple. We're not pointing down because we're not below the downtrend. It's literally that simple. So we're above the downtrend and we're right on the uptrend. We're right on strong support. So we're definitely pointing up. It's bullish. Yes, we're below the. We have an inside bar in the monthly right now. The previous candle is below the previous low. But let's zoom in here to the chart on the 1 hour. Whoa, like crash land right on support. Hit it last week. Hit it again here. It's almost like people are looking at this level here. So we're pointing up. We're on strong support. We could get that failed breakdown. And that's the most important part for me is that, yes, if we do get that failed breakdown, don't get it twisted. It's going to be wrong. Sorry, it's going to be bearish. The question is whether or not we're going to close the candle out there. So ask yourself this. We'll look back to 2 candles right now. So I'm going to delete everything. But we're focusing on this period right here. I'm going to go to full candles. So if we hold the low, that's more bullish. If we don't hold the low, I went through and did the research so you don't have to. What I looked at was this right here, where if we look, we have a lower low on the month, but then ultimately it snaps back and closes up many percent higher. I think it's 8%. So by the end of the month, we close up 8%. Would you regret not being in a rally of 8%? I know I would. And here's the part that's so difficult is that if we're bulls, I said the same thing last month. So again, I might be wrong again. That's definitely possible. Where I said, well, if we're buying all the way up here, we have to be ready to ride it all the way down to 433.02, or basically a monthly higher low. And then we only find out if we're wrong. Well, it's the same thing this month. If we're bullish, I think we have to be ready for a monthly lower low, which means that at some point during the month, we could look completely stupid, silly, or we're going to be even more red. The bears are going to have more conviction. They're going to be lower. But then if we manage to get back above the monthly low for a failed breakdown and then also go higher, that's the recipe I'm looking for. As I look back over time, the recipe has delivered excellent results. And a lot of failed breakdowns happened in 2011. It happened in 2002. It happened in 2022. It's happened over and over. Even happened here in 2021. Not by a lot, but there's a monthly lower low. And then ends up being a bullish engulfing candle. So I don't want to lay out too much more today. I know there's a lot of fear out there, but what I would really encourage you to do is to respect the levels, have a plan, and then stick to it. So please watch the weekend deep dive now queued up here on the left-hand side. If not, maybe you want to come consider joining us for 14 free days to trade with me, Justin from YouTube. If not, thank you so much for tuning in. I will see you tomorrow.